What is tax equivalent yield for municipal bonds? Imagine you're trying to figure out if a tax-free investment is really worth it compared to taxable options. That's where the idea of tax equivalent yield comes into play. It helps you compare the returns of municipal bonds, which are usually tax-exempt, with taxable bonds like corporate or Treasury bonds. Municipal bonds, often called munis, pay interest that is generally not taxed by the federal government. If you live in the same state where the bond was issued, you might also avoid state and local taxes on that interest. Since municipal bond yields are often lower than taxable bonds, just looking at the stated yield doesn't tell the full story. You need to see what the yield would be after taxes to really compare investments. That's what tax equivalent yield calculates. It answers the question, what yield would a taxable bond need to offer so that you get the same after-tax income as a municipal bond? To find this out, you need two pieces of information: the municipal bond yield and your marginal tax rate. Your marginal tax rate is the percentage of tax you pay on your last dollar of income. It depends on your total income and tax bracket. The formula for tax equivalent yield is simple. You take the municipal bond yield and divide it by 1 minus your marginal tax rate. For example, if a municipal bond yields 3% and your marginal tax rate is 30%, the calculation is 3% divided by 1 minus 0.30. That equals approximately 4.29%. So, a taxable bond would need to yield at least 4.29% to match the after-tax income of that municipal bond. This calculation is especially helpful for adults planning their investments. If you are in a higher tax bracket, municipal bonds become more attractive because their tax-exempt status boosts their effective yield. As your income and tax rate go up, the tax equivalent yield also increases, making munis more appealing. When building an investment plan, it's smart to consider your marginal tax rate and use the tax equivalent yield to compare municipal bonds with other fixed income options. This way, you can see which investment gives you the best after-tax return. It's a key part of tax-smart investing, helping you keep more of your money working for you.